Welcome back, everybody. So today I was talking to a friend, and he knows that I mostly trade theta, and he's seen recently that I've not been trading theta. If you've been following me on any of my trades or in the discords, you know I've been selling or actually buying zebras and playing some quick swing trades on Amazon to make a lot of money. And basically he was saying, well, what's up with that? And we got to talking, and he was basically saying, does like selling theta no longer work, or are you too scared to do it now? And the answer is no and yes. So like theta is always gonna be something that works, I think. But am I scared to do it right now? Yeah. Uh, Part of the premium that we collect as theta sellers, or by selling options, is for the risk that we're taking. And usually the implied risk, is higher than the realized risk. But right now, I just can't help but to feel that the market is not taking into account a lot of things going on. The premiums that I've been seeing on stuff that I would normally sell puts on is just not there, and because I just kind of feel like there's a lot of catalysts out there that can say bear market coming in, or at least a downtrending market. And as someone that's normally all bull and I love selling puts, bullish positions, it just doesn't seem worth it. So I'm kind of sitting on the sidelines on that front. So like first off, one of the things I'm looking at is just the VIX even. So just a month ago, this stuff was at 35 or above 35, and then we dipped all the way down to below 20. And even yesterday, as the stock market's going up, I'm sitting here thinking, what's going on? This doesn't make sense. And the VIX is dropping down to 18. It's like the VIX is confirming that we're out of all these crazy waters and everything's gonna be all nice and smooth and going up. Like even the VIX is dropping down. Like I just don't understand it. There's just so much stuff going on in the world right now that I don't know. I have a hard time believing that like the implied volatility is there to make us as the options sellers enough money to justify taking on those risks. I mean, like we're just managing risk and we're trying to get money as a result of doing that. So why am I thinking that the risk is not being reflected in the market right now? Well, there's a lot of different things going on. So one thing obviously is the inflation stuff. Who's been holding up the market right now? All the tech sectors, and they tend to go really well when interest rates are low. As interest rates rise, the value of those stocks tends to go down. So the people holding up the market right now theoretically should lose value as interest rates go up as we try to fight inflation. And okay, so that's just kind of one thing. I mean, how much weight you give that, I don't know. That's up to you. Another thing that is on my radar is this whole inverted yield curve that's going on. Basically, shorter term bonds and are being worth more than longer term ones. Why would that be the case? Like that's basically saying we expect it to be we expect you to pay back your money in the long term, but in the short term, you might be losing your job, so you won't be able to. So that's more risky for us. Like that's what these inverted bonds that they're talking about is kind of referring to. Is that the time ahead, people are saying it's going to be risky. And when you really think about it, like what they're basically saying is people are going to lose their jobs and get a default on stuff. That's why we need a higher interest rate in order to make our money because we think a lot of people are going to default. Whereas like 10 years from now, it's going to be a lot more calmer. That's why this inverted yield thing comes up and a lot of people are talking about it. Uh, Another thing is, I think they say that like this inverted yield thing has predicted like or preceded the last 6 recessions or something like that. I don't know. Do your own research to give it as much weight as you want, but the whole thing about the interest rate for the short term being higher than like the long term is just crazy. Just imagine if you were an option seller and you saw like, oh, a 7-day contract at this strike price is worth more than selling it 30 days out. Like, why is that? Uh, so that's number two. Number three is obviously there's a whole war going on right now. So like three big things right there. I love being bullish and I love selling puts and all that, but right now I just have a hard time doing it because I just think like the risk is not being presented in like the VIX and stuff. So it's not being represented in the premium, and it just seems like one of those things that it's just worth it for me to kind of sit on the sideline a little bit here, maybe just reduce my buying power outlay to a small position. Right now, I've actually don't have any option plays on right now. It's just on my long positions on my income ETFs. Even with the VIX at 21, remember, like, that should be what, 30% of buying power should be used according to that chart I've done in other videos. And I'll see if I can find that chart and put it up here so you can see what it's referring to. But basically, as the VIX increases, you should be putting more of your cash into play so that you can take advantage of that higher implied volatility. Because usually, implied volatility is higher than realized volatility, and that's where option sellers make some money. But the VIX being at 21 right now just seems so low to me, given everything else that's going on. So I'd say whatever percentage that chart says, I'm gonna be putting in here, like, be under that is what I would say to do. But again, remember, I'm just some guy on the internet. Do your own research and trade within your risk profile. And I hope you guys have been doing fine, and I hope it continues to go that way. Thank you for watching, and see you next time.